that nothing in life is worthwhile unless you take risks. Nothing. Nelson Mandela said, "There is no passion to be found playing small and settling for a life that's less than the one you're capable of living."
Trigger bar strategy is the #1 strategy that every beginning trader should master, should excel at for using it before anything else he can do. If he cannot do this simple strategy, he is not going to be successful using patterns. Patterns, they use too much information. This makes trading very, very simple. When the demand hits, you buy. When the supply is higher than the demand, you sell. Trigger bar is going to show you that, and we're going to show you on the chart how it works out. When the bar is big, as you can see this one right here, comparing to the recent bars on the chart, it's called a trigger bar. That's because it triggered the move. It triggers something. Trigger bar reflects the execution of a large order and have a higher probability of follow through in the same direction of the bar. You see here the market is going pretty much sideways, maybe even downtrending. And then suddenly a hedge fund or whatever happens decides he wants to get in on that particular stock. I believe that was a Tesla stock. So he decided he wants to invest in Tesla. And when these guys move money, they move a lot of money. So what happens is when he puts in an order, he doesn't put 100 shares or 500 shares in. That's going to be easily absorbed by the market. He puts a 1 million shares that he wants to buy, and he wants to buy right now. And what happens is the chart shoots right up. Then after what happens, it becomes pebble in a pond effect, which means everybody's going to notice that bar. Whoever notices first gets in on it first, and he's going to go on the same side of the market. So you start seeing this, and then you might go like that, and then the technical traders are going to start buying. It's going to start buying, it's going to start buying, it's going to start buying, it's going to start buying until the move is over. So you have to, as you look at the bar, especially on your cell phone, there's no excuse right now. You can do it in your cell phone. You don't have to have two different screens and computer, and all of this stuff. On your cell phone, the charts are very, very advanced. As soon as you see that humongous bar is formed, you know there's a lot more demand, and therefore you want to get in on that action. The question is where you buy. Where you buy in that bar. Has this bar been confirmed as a bullish bar, or it could be just whoosh, starts coming down? We're going to show you where to buy. The bullish trigger bar strategy tells you not to buy the same bar. The trigger bar only reflects the execution of a large buy order and have a higher probability of a follow through, which is uptrend. So as you see, what happens is that's a trigger bar right there. This particular, here's another chart. This stock is LCID. It's a 5-minute candlesticks. It was going in like very, very, very narrow range, very, very flat, and suddenly out of nowhere, that bar comes shooting through the chart. Where to buy is the question, and we'll show you that. Bearish trigger bar. Here's another example of a trigger bar on the opposite side of the market. Bearish. This particular, it's the same stock, LCID, or I think it's Lucid, and the chart is kind of, you see the candlesticks are very, very, very flat, and suddenly huge bar shows up out of nowhere, and bam, the market follows through. Everything he realizes there's a huge supply. Somebody's dumping shares into the market. Probably an insider, probably a hedge fund, probably a bank, saying that we're no longer interested in Lucid, and therefore they dump their shares. It creates a panic in the market, and everybody has shares, they dump it. Everybody that doesn't have shares, they short that particular stock, and therefore creating a downtrend. So a bearish trigger reflects the execution of a large sell order and have a higher probability of a follow-through decline, of that particular stock. It's very important to differentiate between a bullish trigger bar and exhaustion bar. There's a huge difference between a trigger bar and exhaustion bar. Both of them are large bars. Both of these bars are large bars. The trigger bar happens next to a consolidating period and starts the trend. You see here a very, very flat area, and suddenly this bar starts shooting up and down, showing you there is something going on in the market, and it ends up being a green bar. Therefore, it's a bullish trigger bar. However, if a huge bar shows up at the end of the trend, that's an exhaustion bar. Exhaustion bar shows that this is the last kind of, demand. Whoever is moving the market at this time, whatever hedge fund, whatever banks is buying into this stock, is actually decided to finalize the purchase. This was the last purchase, and therefore the market exhausted. The run is already been exhausted. That's where the names come from, exhaustion bar. So it's very important to determine the difference between exhaustion bar and trigger bar. Do not buy a huge bar at the end of the trend. It's gonna be a huge loss, because what happens is most of the times after exhaustion bar, the market pulls back at least 50%. So trigger bar happens next to a consolidating period and starts the trend. Exhaustion bar on the other side happens after a long run and ends the trend. These are this is a huge point that you have to realize. Here's another example of a bearish trigger bar versus a bearish exhaustion bar. A trigger bar happens after a flat period. It starts the trend downward, starts a decline. Exhaustion bar on the other side, it's already ran for so long, right? It ran for about half an hour, and that particular bar is an exhaustion bar. Just wanted to show you an example of a bearish versus bullish exhaustion bar. If you ever join us, if you ever join our community, we're going to show you some videos as well. We're going to even work with you one-on-one, how to identify single bar strategies, how to buy the green reversal bar or the hammer bar or the inverted hammer bar, how to buy the whole number, when and why. On the other side, if you're a sophisticated trader and you're getting the bullish side, you're getting the buy side good, we're going to teach you the shortened side, because the shortened side is very important, especially in today's market. It's a very bearish market. Therefore, pretty much 70% of your profits are going to come from shortening the market, but you have to understand how to use shortened strategies, how to sell a red reversal bar, how to sell a shooting star, how to sell a hanging man bar, how to sell the whole number, when, where, and why to use the whole number as a natural support and resistance is very important. On your trading plan is going to show it to you just like that. And as you execute your plan, you look at your particular trade, and you're going to say, all right, I'm going to buy the green reversal bar, and you're going to mark that. That's the second step of your trading plan. You're going to mark, doesn't matter if you're going to use that automated PDF format or you're going to print it out and just hand jam it. You're going to write, I bought the green reversal bar. Therefore, after a day, after a week, after a month, when you're reviewing your trades for that particular week, you know what went right, what went wrong, and therefore you can adjust your trading plan from there.